Picture this: you've just watched your retirement savings balloon thanks to a roaring stock market, turning your stocks and shares ISA and pension into something that feels like a dream come true. But then, the anxiety creeps in. What if it all comes crashing down? That's the thrilling yet terrifying reality for many of us right now, especially with the AI frenzy pushing some investments to dizzying heights. But here's where it gets interesting. I've been grappling with this very issue myself, and after some deep reflection, I've devised a straightforward strategy to dial down the risk. Stick around, because this approach might just help you rest easier at night too. Like countless other investors, I've enjoyed substantial growth in my investments in stocks and shares ISA. That's a tax-friendly savings account in the UK, where you can invest in shares and funds, and my self-invested personal pension, or SIPP, a retirement savings plan that gives you more control over investments. The AI revolution has been a game-changer, propelling several of my holdings to new peaks. It's fantastic, no doubt, but the rapid pace of these gains has me a bit on edge. I'm worried about a sudden downturn that could wipe out those profits. So, I've started thinking seriously about ways to reduce the risk in my retirement portfolio without sacrificing everything I've built. Taking profits off the table. I spent a good chunk of last weekend mulling this over, and I crafted a three-pronged plan to trim my exposure to potential volatility, ensuring I can sleep soundly knowing my nest egg is safer. The initial step was all about cashing in on some of those soaring investments by trimming or fully offloading positions that had climbed too high, too fast. For instance, I decided to sell off an AI-focused fund I held. Why? Because I realized I already had plenty of overlap with its holdings, like shares in Nvidia, through other investments in my portfolio. Holding onto it felt like overexposure, amplifying my risk unnecessarily. This move generated some liquid cash, which I could then redeploy strategically. Think of it as harvesting gains before they evaporate, a classic tactic to lock in wins while avoiding the sting of a market reversal. Rebalancing for broader stability. With that cash in hand, the second leg of my strategy shifted to diversifying into market segments that aren't as closely tied to the tech and AI bubble. This rebalancing act helps spread risk, much like not putting all your eggs in one basket, a fundamental investing principle that even beginners can appreciate. I channeled funds into European equities and the healthcare industry using exchange-traded funds, ETFs, which are like baskets of stocks you can buy and sell on the stock exchange easily. For the European angle, I chose the iShares Core MSCI Europe UCITS ETF. Sure, it includes some tech exposure, but its composition is far more balanced compared to something like a S&P 500 index fund, which is heavily US-centric. On the healthcare front, I went with the Xtrackers MSCI World Healthcare UCITS ETF, granting me entry to a diverse array of top-tier global healthcare companies. These moves are designed as safeguards. If AI-driven tech stocks tumble, these sectors could provide a buffer, keeping my portfolio resilient. And this is the part most people miss. Diversification isn't just about owning more. It's about selecting uncorrelated assets that can weather different storms, potentially smoothing out returns over time. Exploring defensive dividend pairs. The third element of my plan, which I'm still refining, focuses on directing funds toward individual stocks that are inherently more stable. These are defensive investments, companies that tend to hold up better during economic turbulence, particularly one tied to AI disruptions. I'm aiming to boost my stake in reliable businesses that won't implode if tech takes a hit. While I'm still digging into options, one that stands out is Coca-Cola HBC, traded on the London Stock Exchange under the ticker LSE, CCH. As a key bottling partner for the American giant Coca-Cola, it plays a crucial role in distributing their drinks worldwide. What drew me to this stock? First, it's recently experienced a significant dip in price, making it look undervalued once more. At the moment, it boasts a forward price-to-earnings (P/E) ratio of 14. This is a valuation metric that compares a company's stock price to its earnings per share, helping investors gauge if it's cheap or expensive relative to its profits. For context, a lower P/E often signals better value, though it's not the only factor to consider. Additionally, its projected dividend yield for 2026 is around 3.5%, offering an attractive income stream, ideal for retirement-focused portfolios where steady payouts can supplement savings without constant selling. The second compelling factor was insider buying. In October, two directors plunked down about £385,000 of their own money into the company. Insiders typically purchase shares when they believe strongly in the future. It's a sign of confidence from those who know the business best. This insider enthusiasm piqued my curiosity, reinforcing my view that it might be a solid pick. Of course, no investment is risk-free. Coca-Cola HBC faces potential hurdles like geopolitical tensions, disruptions in supply chains, or shifts in consumer tastes toward healthier options. But at these levels, it seems appealing to me, worth considering for anyone building a defensive core in their portfolio. But here's where it gets controversial. Some might argue that selling high-flying AI stocks now is premature, potentially missing out on even more upside. Is it smarter to hold through volatility for long-term gains? Or is protecting profits the wiser move for retirees? What do you think? Does this strategy resonate with your approach to retirement investing? Do you lean toward aggressive growth or playing it safe? Share your thoughts in the comments below. I'd love to hear differing perspectives and spark a discussion on balancing risk and reward in today's unpredictable markets.